didn't feel like I was echoing the conventional wisdom at the time. And David, nobody knows yet, and it's too early to know, and the record of forecasters isn't great. But I have to say that whether you look at average hourly earnings, whether you look at producer prices, whether you look at consumer prices, whether you look at direct measures of labor shortage, whether you look at market expectations of inflation, whether you look at survey expectations of inflation, I was on the worried side about inflation, and it's all moved much faster, much sooner than I had predicted, and I think that has to make us nervous going forward.
Yeah, no question about it. At the same time, we have a number of people who continue to say it's not that big a problem. They have various reasons for that. One thing they say is it's just specific sort of kinks in the supply chain that isn't a larger phenomenon. What do you say to them?
So look, by definition, there are always going to be a few components of the CPI that grew rapidly in any given month. That's what the Carter economists said all through the creation of the great inflation. I think there's some things that are striking. If you look at core CPI this month, it grew faster than headline CPI. That's exactly the opposite of what that idea would tend to predict. If you look at the pace of inflation, it seems to be accelerating. What I'm struck by is how selective people are. I mean, the thing that leaps out at me when I do microeconomic analysis of the price indices is that house prices, by some measures, are up 18% over the last year, but the owner-occupied housing component of the CPI is up like 2%. And so that tells me that we're probably missing something large with respect to housing. And I think if people are seeing their house prices go up at 18%, before too long, they're going to be estimating that the amount they could rent their houses for is going to be going up substantially. So the largest distortion I see in the numbers is with respect to housing. You know, so many people commented on used car prices, and used car prices, surely that's not a trend that's going to continue, but it's only a couple percent, if that, of the index. If you look at the monthly CPI, medical care was zero in the most recent reading. I don't believe for a moment that medical care prices are going to stay at zero, and that's a much larger component of the CPI than used car prices. So it may be that it's going to change. The other thing to say is, let's be clear, the core CPI grew at 0.9%. That's an annual inflation rate above 11%. So there's plenty of room for there to be a lot of transitory factor in it, and for us still to have what would be an extremely serious problem of inflation rising to the 4% range. So I don't think you can dismiss these figures. I also think that if you look at the hourly earnings figures, if you look at the producer price things, all the inputs which have to do with future price increases, those seem to be accelerating as well.
So, Larry, what do you say to the Fed, frankly, who keeps saying it's transitory? And specifically, the argument, as I understand it, is, look, and what we're seeing right now is the necessary reaction of economy coming back online. And once it gets back online, things will settle back down again. So this is just like a relatively short one-off.
Look, anything's possible, and they could be right. But I always believe in government that the right strategy, indeed in life, the right strategy is to hope for the best and plan for the worst. And the Fed seems to be planning for a very benign scenario